Problem 15-2A, Stock Investments, Transactions, Trading Securities, page 718 to 719 of your textbook. Schofield Financial Company is a regional insurance company that began operations on January 1, 2016. The following transactions relate to trading securities acquired by Schofield Financial Company, which has a fiscal year ending on December 31st. Our instructions are to journalize the entries to record these transactions. Second, prepare the investment-related current asset balance sheet presentation for Schofield Financial Company on December 31st. 3. How are unrealized gains or losses on trading investments presented in the financial statements of Schofield Financial Company? 2016, March 14th, purchased 5,000 shares of Wilcombe Inc. as a trading security at $40 per share, plus a brokerage commission of $500. To come up with the amount of cash that is being paid out for this investment, we would take the 5,000 shares that we are purchasing times the $40 per share, and then add the brokerage commission of $500 to this amount. To journalize it, we would debit the investment we are purchasing and credit cash. The total amount of the number of shares times the share price plus the commission comes to $200,500. On April 24th, we purchased 1,800 shares of McMarsh Inc. as a trading security at $50 plus a brokerage commission of $198. This entry would be the same as March 14th except for the name of the company in which we are investing in. So we would take the 1,800 shares times $50 per share plus the brokerage commission of $198. This would be a total of $90,198. Of course, the debit entry would be to the investment in McMarsh and a credit entry to cash. On June 1st, we sold 2,600 shares of Wilcombe Inc. for $38 per share, less a $100 brokerage commission. To arrive at the amount of cash we are receiving, we would take the 2,600 shares times the $38 per share, and then we would subtract the $100 brokerage commission. To find the amount that we should credit to the investment in this particular entry, because we are selling it and we need to take them off our books, we have to consider what was the basis in our per share amount of Wilcombe Inc. To find our basis in the shares for the Wilcombe Inc., we should have originally taken the total amount that we paid for the 5,000 shares, which was the $200,500, and divided it by the 5,000 shares. This would have given us a basis per share of $40.10 per share. On the June 1st entry, then what we would do is when we go to record this, we're going to debit cash for the amount of cash that we receive. We should credit the investment in Wilcombe for the amount of the shares times our basis, and then using that information, we should be able to determine whether we had a gain or a loss on the sale of our investment. Just a cursory look tells us that at $38 a share that we're selling it for is less than the $40 a share that we paid for it, so we are going to incur a loss. To record this transaction, we would debit cash, determine that we will have a loss, and finally we need to credit the investment in which we are selling. Now we would take the 2,600 shares times the basis, which was $40.10, to arrive at the amount that we would credit to the investment that we are taking off of our books. That would be a total of $104,260. Also remember, to figure the amount of cash that we are receiving, we would take the number of shares that we sold the stock for and then subtract the amount of the commission that was charged to us. So in this case, we sold 2,600 shares, $38 per share, and then subtract the $100 brokerage commission. That would give us a total amount of cash of $98,700. The difference between the cash and what the basis was in the stock will tell us what the amount of the loss on our sale of our investment would be, which would be $5,560. June 30th, we received an annual dividend of 35 cents per share on Wilcombe Inc. stock. Now, to determine the amount that we should receive in dividends, we should know how many shares we still have. Remember that we originally purchased 5,000 shares, but we just sold 2,600 of them, which means we have remaining with us 2,400 shares. And because these are trading securities, we do not have a significant influence in this company. We would use the entry of we are receiving cash, and this would be called dividend revenue. The amount that would record is the 2,400 shares that we still have times the dividend per share, which was 35 cents, which is a total of $840. On December 31st, the portfolio of trading securities was adjusted to fair values of $38 and $49 per share for Wilcom and McMarsh Inc. respectively. These are one of the few things that are either written up or written down to their fair market value when it comes to assets. And we would determine how to write this up or down by basing it on what was our cost and what the market is selling at the time. Using a little schedule such as this, we would look at what our cost is for Wilcom, what our cost is for McMarsh, figure what the total fair value is for each, and then determine whether the fair value is more than or less than our cost. Remember that for cost for Wilcom, we only have 2,400 shares of the stock left at a basis of $40.10, which is our cost. Taking the $40.10 times the 2,400 shares gives us a total cost of $96,240. For McMarsh, because we still have all of the investment that we purchased, we know that originally we paid $90,198. This gives us total costs of those two amounts added together of $186,438. To find the fair value, we would take the number of shares of stock that we still have in each investment times what the market price is at the time we file. For the fair value for Wilcom, the market price was $38 per share. 2,400 shares times $38 gives us $91,200. McMarsh, we originally purchased 1,800 shares, and at the moment they are selling for $49 per share. So the 1,800 shares times the $49 per share is a market value of $88,200, coming to a total fair value of $179,400. Determining how you will make your adjustment at the end of the year to either mark up or mark down to the proper fair market value. Take the fair value and subtract cost from it. If the number is negative, then we had a decrease in our market value. If it is positive, then we had an increase in our market value. So subtracting $186,438 from $179,400 gives us a negative $7,038. Otherwise, we have what's called an unrealized loss on our trading securities. To record this, we debit an account called unrealized loss on trading investments and credit what's called valuation allowance for trading investments. The amount that is recorded here is the $7,038. 2017. April 4th, purchased 3,500 shares of Daily Inc. as a trading security at $30 per share plus a $175 brokerage commission. This is similar to the other transactions we had. We would just record that we have an investment in Daily Inc., credit cash, and it will be for 3,500 shares times 30 plus the $175 commission. Please note that the wrong date is on the spreadsheet here. This should be 2017, not 2015. So for the April 4th investment, we would record investment in Daily Inc., a credit to cash, for $105,175. On June 28th, we received an annual dividend of 40 cents per share on Wilcom Inc. stock. Remember that we own 2,400 shares. So to arrive at the annual dividend revenue we need to record, we would take the 2,400 times the 40 cents per share. So on June 28th, we debit cash, credit dividend revenue for $960. September 9th, we sold 700 shares of Daily Inc. for $32 per share, less a $50 brokerage commission. When we purchased the Daily Inc. stock, we should have figured out what our basis was per share. The total amount that we paid for it was $105,175. If we divide that by 3,500 shares, we would come up to a per share amount of $30.05 per share. A cursory look tells us that we're selling it for $32 per share. We originally only paid $30, so this should be a gain on the sale of this investment. So to figure out the amount of the gain, we would determine how much cash we received. Remember, that would be the number of shares we sold times the price per share we sold it at, minus any commissions that we paid. Then we would credit our investments for the number of shares we sold times our basis, which is $30.05 per share. The amount of cash we would receive in this transaction would be $22,350. The number of shares that was sold in this transaction at basis would be the 700 shares times $30.05 per share, or a total of $21,035. The difference between these two amounts would give us the gain on the sale of our investment, which is $1,315. On December 31st, the portfolio of trading securities had a cost of $270,578 and the fair value of $350,000. This tells us that our cost is now less than our fair value. If we subtract $270,578 from the $350,000, we arrive at an amount of $79,422. So the amount that we need to make as an adjustment here, however, will be just a little bit different. Remember, we had recorded an unrealized loss in the last period, so it means that we need to actually make the adjustment for a little bit more than the $79,422. Because we're going to change a credit balance in our valuation allowance for trading investments from a credit balance of $7,038 to a debit balance of $79,422. This total amount would come to $86,460. That is all of our journal entries to be recorded. 2 says, prepare the investment-related current asset balance sheet presentation for Schofield Financial Company on December 31st, 2017. So we are just looking at the current asset section of the balance sheet. First, we record our investments at our cost. If you recall from the last journal entry, it told us our cost was $270,578. We would now put the valuation allowance. In this case, since it is a debit balance, that means we would be adding. So we would put the $79,422, which should be the debit balance now in that account. And those two amounts added together will bring the trading investments up to what is considered the fair market value at the time, which was the $350,000. Part 3 says how are unrealized gains or losses on trading investments presented in the financial statements of Schofield Financial Company. We will not answer this part in the problem. You will be required to answer that when you do your assignment. And that is the end of this problem.